The question of whether XRP could fundamentally transform global finance and reach astronomical price levels like $10,000 per token has captivated both cryptocurrency enthusiasts and skeptics for years, representing one of the most contentious debates in the digital asset space. To truly understand this question, we must first examine what XRP actually is, how it differs from other cryptocurrencies, and what unique position it might occupy in the future financial ecosystem. The journey from understanding XRP's current role to imagining its potential future requires us to separate speculative hype from fundamental technology and real-world adoption possibilities. Unlike Bitcoin, which was created as a peer-to-peer electronic cash system, XRP emerged from a very different vision, one centered on facilitating rapid, low-cost international payments between financial institutions. This distinction is crucial because it means XRP's success cannot be measured solely by its ability to serve as a store of value or medium of exchange for everyday consumers, but rather by its utility in solving real problems that banks and payment networks actually face. When examining whether XRP could take over the financial system, we're really asking whether distributed ledger technology, and XRP specifically, could become so integral to how money moves globally that it becomes indispensable to traditional finance. The foundation of any serious analysis about XRP's potential requires understanding the actual technology that powers it and the ecosystem built around it by Ripple Labs. The XRP ledger, which has existed independently of Ripple's corporate operations since 2012, operates as a decentralized payment settlement network that can process transactions in approximately 3 to 5 seconds at a fraction of the cost of traditional international wire transfers. What makes this particularly compelling is that the XRP ledger doesn't require mining like Bitcoin or proof of stake like Ethereum, instead using a consensus mechanism called the XRP Ledger Consensus Protocol, which relies on a network of validators to agree on transaction validity. Ripple, the private company, developed products like RippleNet and later on Demand Liquidity, formerly XRapid, that utilize XRP as a bridge currency for cross-border payments, allowing financial institutions to move money between countries without maintaining expensive Nostro accounts. This is genuinely innovative because the current system for international payments is slow, expensive, and requires banks to hold significant amounts of currency in accounts around the world just to facilitate transactions. The blockchain layer underneath, XRP, is designed for speed and efficiency rather than decentralization maximalism, which makes it more suitable for enterprise use than some other blockchain platforms. Understanding this technology is essential because XRP's path to dominance would depend entirely on whether institutions actually adopt these systems and whether the advantages over existing infrastructure prove significant enough to justify switching. Oaking at real-world adoption and partnerships reveals a more nuanced story than either the most bullish supporters or the harshest critics typically acknowledge. Ripple has announced partnerships with hundreds of financial institutions, payment providers, and remittance companies around the world, including major banks and payment networks that collectively handle enormous transaction volumes. These partnerships demonstrate that there's genuine institutional interest in the technology and that some of the world's largest financial institutions believe the innovation has merit worth exploring. However, there's a critical distinction between announcing partnerships and actually using XRP itself in significant transaction volumes, which is something the skeptics rightfully point out. Many of these partnerships use Ripple's technology infrastructure, but not necessarily XRP tokens themselves, a crucial difference that matters enormously for the cryptocurrency's valuation. The companies testing on-demand liquidity services with actual XRP tokenization represent a smaller subset, though the numbers have been growing, and include legitimate financial institutions processing real transactions. For XRP to truly take over finance, we would need to see a quantum leap in adoption where using XRP becomes standard practice for banks, rather than an experimental service tested at the margins of their operations. The regulatory environment, particularly the ongoing legal situation between Ripple and the SEC in the United States, has created uncertainty that has probably slowed adoption momentum during a critical period when other blockchain solutions were also racing to gain institutional traction. The SEC lawsuit and its outcomes represent perhaps the single most important factor determining XRP's future potential in traditional finance, making it essential to understand what's at stake in these legal proceedings. The SEC alleged that XRP should be considered a security rather than a currency, which, if determined to be true, would have massive implications for how it could be used and traded. The lawsuit's resolution has been partially favorable to Ripple, with the judge determining that XRP itself is not a security in a secondary trading context, which allowed exchanges to continue listing it for trading by regular investors. However, questions remain about whether XRP might be considered a security in other contexts, and Ripple's corporate use of XRP proceeds could face additional scrutiny. This legal ambiguity has created a risk that deters some traditional financial institutions from integrating XRP too deeply into their core operations, since a future unfavorable ruling could create compliance nightmares. Compare this to Bitcoin or Ethereum, which, while also legally murky in many jurisdictions, have at least achieved a kind of pragmatic acceptance from regulators and institutions who've decided they're not securities. For XRP to achieve the kind of systemic importance that would justify a $10,000 price, it would almost certainly need complete regulatory clarity and acceptance as a non-security utility token, something that remains unresolved. The geopolitical dimension also matters. Other countries might embrace XRP more readily if their regulations differ from the United States, potentially creating scenarios where XRP dominates certain regional payment networks, even if it faces limitations in America. This fragmented global adoption pathway is actually quite realistic, even if it doesn't lead to the kind of total takeover scenario that XRP maximalists envision. To evaluate whether $10,000 per XRP is not impossible, we need to engage seriously with both the mathematics evaluation and the economic scenarios that would need to occur for such a price to make sense. Currently, there are approximately 53 billion XRP in existence, with perhaps 45 billion in circulating supply, depending on how you count tokens held in Ripple's escrow accounts. If we assume relatively minimal inflation from new token issuance, a price of $10,000 per XRP would result in a market capitalization of roughly $450 trillion, which would be many times larger than the entire global money supply, the global stock market, all real estate, and every other asset combined. To put this in perspective, this would mean XRP would be worth more than all the gold ever mined, all the world's currencies, all financial securities, and all real estate simultaneously. Mathematically, this would require XRP to represent not just the payment infrastructure, but literally all value in the world, which is not a realistic scenario under current assumptions about how economics works. However, if we adjust expectations to something like $100 or even $500 per XRP, which is still astronomical compared to the token's all-time highs, the market cap would be in the $5 to $25 trillion range, still larger than any current asset class, but at least in the realm of plausible, if extremely bullish scenarios. These higher valuations would make sense only if XRP became so central to global finance that the ecosystem using it represented a significant fraction of all economic activity. Some advanced thinkers in this space argue that in a future where blockchain-based value transfer replaces a substantial portion of traditional banking infrastructure, tokens could acquire larger total market caps than we'd expect today. But this requires genuine transformation of the financial system rather than simple adoption alongside existing structures. The comparison between XRP and other potential payment system tokens reveals both XRP's advantages and the fierce competition it faces in this critical space. Bitcoin advocates argue their token is superior as a payment system because of its greater decentralization and proven track record, though Bitcoin's transaction speed and cost profile make it suboptimal for merchant transactions. Ethereum and other smart contract platforms could theoretically facilitate payment systems that rival or exceed XRP's capabilities, and projects building on top of these platforms like stablecoin systems are indeed becoming serious competitors for real-world transaction volume. Newer proof-of-stake blockchains like Solana, Cardano, and Polkadot offer rapid transaction settlement and low costs, potentially undercutting XRP's technical advantages. Central bank digital currencies, CBDCs, which several countries are actively developing and testing, could end up being the solution that banks prefer to use, since they'd provide the speed and efficiency benefits without requiring adoption of a privately issued token. The competitive landscape means that even if XRP's technology is sound and its partnerships genuine, it faces an increasingly crowded field of alternatives, each with backers and unique advantages. What matters most isn't whether XRP is good technology, it demonstrably is, but whether it becomes the preferred standard that a significant majority of financial institutions choose to use. Network effects are crucial in payments infrastructure, meaning the more institutions using a particular system, the more valuable it becomes to join that system, creating winner-take-most dynamics. If XRP can establish itself as the standard for cross-border settlement and retain leadership as newer competitors emerge, it has a genuine pathway to massive adoption if it gets supplanted by a CBDC, Bitcoin, Ethereum-based solutions, or some other competitor. Its price would be capped by its reduced utility. The role of XRP in creating a more efficient and equitable global financial system deserves serious consideration beyond mere price speculation. Currently, international payments are slow, expensive, and maintain significant barriers for developing nations and unbanked populations, with fees and delays that disproportionately affect those who can least afford them. A payment infrastructure based on distributed ledger technology and XRP could theoretically democratize access to the global financial system, allowing instant settlement between any two parties at minimal cost, regardless of geography or existing banking relationships. This has profound implications. And OT just for banks, but for remittances to developing countries, cross-border commerce, and financial inclusion. Individuals in countries with unstable currencies or limited banking infrastructure could theoretically access global financial markets more easily if a standard like XRP became ubiquitous. The efficiency gains from faster settlement could free up enormous capital currently locked up in nostro accounts and in-flight payments, releasing resources for productive economic activity. From this perspective, XRP's potential takeover of finance isn't about a cryptocurrency bubble enriching speculators, but about genuine infrastructure improvement that benefits the global economy. However, this outcome would require not just adoption by some institutions, but by enough of them to substantially displace current payment rails, which is a much higher bar than merely having partnerships and successful pilots in limited contexts. The path from niche adoption to systemic importance is rarely smooth or inevitable, and many promising technologies have failed to achieve the ubiquity necessary for dominance, even when they offer genuine advantages. Examining the regulatory and geopolitical dimensions reveals additional complexity in assessing whether XRP could truly dominate global finance. The United States, despite being Ripple's home and where much of the company's operations and partnerships are based, has created regulatory uncertainty through the SEC lawsuit and other enforcement actions that might actually slow XRP adoption in the world's largest economy. Meanwhile, other jurisdictions like Singapore, Japan, the United Arab Emirates, and several Latin American countries have adopted more crypto-friendly regulatory frameworks that could make XRP adoption more attractive to financial institutions in those regions. It's entirely plausible that we could see a future where XRP becomes dominant in certain regional payment networks, say across Southeast Asia or Latin America, without achieving the kind of global dominance that would push prices to astronomical levels. The geopolitical context also matters because if the United States maintains hostility toward XRP while other superpowers embrace it, we could see bifurcation where multiple payment standards compete regionally rather than one system achieving global dominance. China's development of its digital yuan and its own blockchain infrastructure suggests that countries might prefer to develop domestic or regional payment standards rather than relying on a privately issued token that could be subject to foreign control or sanctions. This multipolar payment infrastructure future is actually quite realistic, and it would meaningfully cap how large XRP's utility and price could become. Even if XRP became genuinely important and widely adopted, the existence of competing standards for other regions would limit the ceiling on its total value. A truly world-dominating scenario would require an unlikely convergence toward a single standard, which seems against the grain of how governments and major institutions actually behave when it comes to critical infrastructure The investment perspective on XRP reveals the tension between fundamental utility arguments and speculative price dynamics that characterize much cryptocurrency discussion. From a pure investment standpoint, XRP's price is ultimately determined by supply and demand among buyers and sellers, which is influenced by, but not directly tied to fundamental utility and adoption levels. Retail investors have poured capital into XRP during bull markets, driven by narratives about coming adoption and price upside, creating price spikes that far exceed what current adoption levels would suggest. During bear markets, the narrative reverses, and the lack of consumer-facing applications and limited current transaction volume become prominent talking points. This dynamic creates tremendous volatility, where XRP's price might soar on positive news about partnership announcements or regulatory developments, then crash when those partnerships fail to translate into actual usage or when broader cryptocurrency markets decline. Sophisticated investors recognize that buying XRP based on a $10,000 price target narrative requires believing that fundamental adoption will increase dramatically and that current supply levels will seem tiny relative to utilization. This is a multi-year high-risk bet that depends on events outside the token's technical merits, regulatory changes, institutional adoption decisions, and competitive positioning. Some people genuinely believe these events are likely and that XRP is undervalued relative to its potential, making it a reasonable asymmetric bet despite the risks. Others see the massive gap between current usage and the adoption levels necessary to justify such valuations and conclude that XRP is already fairly valued or overvalued at current prices. The honest answer is that uncertainty dominates here. Reasonable people with similar information can reach genuinely different conclusions about XRP's future price. Examining the technical limitations and scalability challenges of any payment system token provides important grounding for assessing the physical constraints on potential adoption. The XRP ledger, while impressively fast compared to Bitcoin and traditional banking, still has throughput limitations that could create constraints if adoption became extremely widespread. Most blockchain-based systems face a fundamental trilemma between decentralization, security, and scalability, where optimizing for one typically requires compromising on the others. XRP's design prioritizes speed and low cost, which necessarily means it has sacrificed some degree of decentralization compared to Bitcoin, relying on a relatively small set of trusted validators. This design choice might be perfect for its intended use case of institutional payments, but it means XRP isn't as censorship resistant or decentralized as some cryptocurrency purists would prefer. If XRP scaling to handle truly global payment volume, it would likely need layer 2 solutions or side chains built on top of it, adding complexity and potential security considerations. The technology landscape is also dynamic, meaning that by the time XRP achieved massive adoption, other platforms might have solved scalability problems more elegantly, potentially making them superior choices going forward. Technical superiority is important for long-term success, but it's neither necessary nor sufficient for dominance. Sometimes the first solution to achieve critical mass wins regardless of whether better alternatives subsequently emerge. These technical considerations suggest that while XRP can theoretically scale to very large transaction volumes, significant engineering challenges would need to be solved, and the solution might not be as straightforward as advocates hope. The institutional adoption narrative, which is central to the bullish case for XRP, requires examining specific examples and understanding why adoption has been slower than many predicted. Ripple announced partnerships with hundreds of financial institutions, but the distinction between testing the technology and deploying it in production at scale is enormous. Some partnerships ended after initial pilots, suggesting that when companies actually tried to integrate XRP, they encountered obstacles, whether technical, operational, or related to internal corporate processes that made them hesitant to proceed. Other partnerships have been knowing for years without expanding beyond limited use cases, suggesting that the value proposition, while proven in theory, might be insufficient to justify switching from existing systems at the scale institutional decision-making requires. Banks are risk-averse and maintain massive technology infrastructure investments that work, even if imperfectly, and switching to new systems is costly and disruptive. For XRP to achieve true dominance, it would need to overcome institutional inertia and demonstrate advantages so compelling that even risk-averse banks feel compelled to upgrade. This is an extremely high bar, and the gradual pace of actual XRP implementation in the years since Ripple's founding suggests this bar is higher than initially imagined. That said, it's entirely possible that adoption accelerates from here if enough institutions simultaneously decide that the infrastructure costs have risen to crisis levels and XRP or similar solutions represent the most viable upgrade path. The pandemic-era discussion of infrastructure modernization in banking suggests renewed appetite for such improvements, but whether this translates to XRP specifically remains uncertain, considering the macroeconomic scenarios in which $10,000 XRP becomes plausible helps clarify what would actually need to happen for such valuations. The first scenario would involve global adoption where XRP truly becomes the standard for interbank settlement, handling perhaps 30 to 50% of all international payments globally, while other systems handle the remainder. In this scenario, XRP would be transactional, moving enormous volumes daily but not appreciated as a store of value, yielding a price well below $10,000 in real terms. The second scenario involves XRP becoming a major reserve currency and store of value that central banks and institutions hold as insurance against monetary instability, similar to how gold and dollar reserves function currently. This would elevate XRP from purely transactional to a store of wealth, significantly increasing its value. The third scenario involves a fundamental loss of confidence in fiat currencies or existing payment infrastructure that drives massive new demand for alternative systems, including XRP, as people and institutions seek alternatives to failing institutions. This tail risk scenario could theoretically push prices to extreme levels, but requires a genuine crisis and collapse of confidence, which is dystopian. The fourth scenario involves unexpected technological breakthroughs, network effects, or competitive dynamics where XRP unexpectedly dominates the emerging digital asset ecosystem and becomes so culturally and economically central that its value accrues at levels similar to major world currencies. A $10,000 price is realistically plausible only in combinations of these scenarios, particularly if XRP achieves both transactional dominance and significant reserve currency status. Such outcomes are possible, but would require an unusual convergence of favorable circumstances, making high valuations speculative rather than based on current evidence. The role of speculative capital flows and market psychology in driving XRP's price requires honest acknowledgement of how cryptocurrency markets actually function. Cryptocurrencies are unique in that they have no cash flows, no earnings, and no intrinsic consumption that determines value the way it does for stocks or commodities. A Bitcoin, Ethereum, or XRP token is worth what the next buyer is willing to pay for it, making these markets extremely susceptible to momentum, narrative-driven rallies, and speculative bubbles. XRP has experienced multiple boom-bust cycles where euphoric narratives about imminent adoption drove prices to highs, followed by disappointment and cheer-a's when adoption failed to materialize as quickly as expected. The 2018 bull market saw XRP rally dramatically on partnership announcements and adoption optimism, which was followed by years of declining prices as reality lagged the hype. The 2021 bull market saw another massive rally before the broader crypto drawdown, and the cycle might repeat again if circumstances align. These cycles indicate that XRP's price is heavily influenced by sentiment and speculation, not just by adoption fundamentals. Importantly, this doesn't mean XRP will necessarily fail or that its price can't reach extreme levels. Speculative bubbles are real and can inflate asset prices to extraordinary levels for extended periods. However, it does mean that reaching and maintaining a price of $10,000 would require not just adoption, but also a sustained speculative narrative that captures the imagination of capital markets. The question of whether such a narrative could emerge and endure is essentially unpredictable, dependent on factors like media coverage, celebrity endorsements, regulatory developments, and pure luck. Understanding the difference between short-term price movements and long-term value creation is crucial for assessing XRP's realistic prospects. In the short term, defined as days, weeks, or even a few years, XRP's price is determined almost entirely by supply and demand dynamics, sentiment, and speculative flows, which can be wildly disconnected from any fundamental measure of value. Large price movements can occur based on minor news items, celebrity tweets, regulatory announcements, or merely the momentum of technical price movements. This is why cryptocurrencies are notorious for dramatic short-term price swings that dwarf the swings in more traditional assets. In the long term, defined as many years or decades, the price of an asset should correlate more closely with its utility and the economic value it facilitates or stores. For XRP, this long-term value depends entirely on whether it achieves meaningful adoption in real financial use cases and whether users derive genuine economic value from using it. If XRP ultimately fails to achieve significant institutional adoption and remains a niche asset primarily traded by speculators, its long-term price would likely be far below current levels, perhaps approaching zero as the excitement fades. Conversely, if XRP achieves its bullish adoption scenario, its long-term value would be far higher than current prices, making it a genuine wealth transfer from skeptics to believers. The honest assessment is that both scenarios are possible and the path forward remains genuinely uncertain. Investors betting on XRP reaching $10,000 are essentially making a long-term adoption bet where they believe the market will eventually value XRP at levels that justify such prices. This is a legitimate investment thesis, but one that requires significant belief in a future scenario that hasn't yet materialized. Exploring the possibility of XRP achieving dominance in specific niches rather than systemic financial dominance provides a more realistic path to meaningful success. Rather than conquering the entire global financial system, XRP might become the dominant standard for remittances between specific countries, say from the United States to Latin America or from the Middle East to Southeast Asia. It might become the preferred settlement layer for specific types of financial institutions like smaller regional banks or payment service providers that lack the resources of major global banks. It might dominate in cryptocurrency to fiat on-ramps where institutions are actively converting between digital and traditional assets. In each of these scenarios, XRP would be genuinely important and valuable, potentially worth FA. Are more than current prices, but without achieving the systemic dominance that would justify astronomical valuations. These niche dominance scenarios are arguably more likely than total system takeover because they require less disruption to existing systems and less cooperation from incumbent financial institutions. The distributed pathway where XRP dominates in some regions and specific use cases while other solutions dominate elsewhere is realistically plausible and could create genuine value. For investors, this raises a question about whether partial dominance is sufficient to justify current prices or whether the investment case requires total dominance to make sense. A token could increase in value by 10 times or 100 times by dominating specific niches even while other solutions dominate globally, making XRP a decent investment even if the takeover narrative never fully materializes. The comparison with how other major infrastructure technologies achieve dominance historically reveals patterns relevant to XRP's prospects. The internet, electricity grids, telephone networks, and railroad systems all went through adoption curves where early versions were slow, expensive, and unreliable compared to existing solutions. Yet over time, their advantages became so compelling that they achieved dominance. These transitions typically took decades and involved not just technology improvements, but regulatory frameworks, industry standards, business model innovation, and often regulatory intervention. The winners in these transitions were not always the first movers or the most technically superior solutions, but rather those that achieved critical mass and network effects first. Applied to XRP, this history suggests that institutional adoption and payment settlement is realistic and could follow a similar S-curve, starting slowly then accelerating once enough institutions have adopted to create network effects. However, it also suggests that such transitions take longer than enthusiasts typically expect, and that other competitors might emerge during the adoption process, potentially displacing early leaders. Digital currencies like CBDC platforms or other blockchain-based payment systems could potentially disrupt XRP's trajectory, even if XRP were making progress toward adoption. The historical pattern also suggests that the assets that profit most from infrastructure transformation are often not those directly involved in the infrastructure, but those leveraging it in new ways, which might argue for focusing on applications and services using XRP rather than XRP itself. Assessing the probability of various outcomes for XRP requires acknowledging irreducible uncertainty and the limits of prediction. We can construct plausible scenarios ranging from XRP becoming a major component of global payment infrastructure to XRP fading into irrelevance and being displaced by superior competitors or technologies we haven't yet anticipated. We can examine the evidence for and against each scenario, the partnerships and adoption progress supporting the bullish case, the slow pace of actual deployment, and competitive challenges supporting the skeptical case. We can even assign rough probability estimates based on historical patterns and fundamental analysis. However, we cannot make confident predictions because the outcome depends on many contingencies, including regulatory changes, technological breakthroughs, competitive dynamics, and the decisions of powerful institutions who might move at any time. The cryptocurrency and blockchain space is young and dynamic, with developments that would have been unimaginable 10 years ago now being real and commonplace. In this environment, intellectual honesty requires acknowledging that both the believers in XRP and the skeptics could be proven right, and the key variables determining the outcome remain genuinely uncertain. This uncertainty is precisely why cryptocurrency investments remain high-risk propositions, appropriate only for those who can afford to lose their investment and who have done sufficient research to understand the downside scenarios as well as the upside. Concluding thoughts on the OMG XRP is taking over the financial system narrative reveal that it's partially true, somewhat exaggerated, and dependent on developments that remain uncertain. XRP is genuinely a credible technology with institutional backing and real use case potential in cross-border payments, making it more than pure hype. However, the adoption path has been slower than optimistic observers predicted, competition has intensified, and the regulatory environment remains uncertain, making simple narratives about XRP dominance premature. The $10,000 price target might ultimately prove conservative if XRP achieves complete dominance in global payment settlement and becomes a significant reserve currency, but it would also require XRP tokens to represent a market cap so enormous that skepticism about such valuations remains reasonable. The realistic range of outcomes probably spans from XRP becoming a significant niche player in payment infrastructure with prices many multiples higher than current levels, to XRP achieving broader adoption that justifies much higher valuations, to XRP failing to achieve critical mass and declining in relevance and price. Rather than making categorical predictions, the prudent approach is to recognize that XRP has genuine potential while maintaining awareness of the substantial risks and acknowledging that the future is fundamentally uncertain. For those considering XRP as an investment, the honest message is that it represents a speculative bet on an uncertain future where upside potential exists alongside significant downside risk. And position sizing should reflect this reality rather than the certainty that some rhetoric suggests.